Good morning, everyone, and thank you for joining us both here and in the room and online. I'm Mike Discenza, our Chief Financial Officer, and many of you know I began in this role as the CFO in August of last year, but I have been with Timken for over 25 years now. And while it's obvious this is my first time at Investor Day in this role, it's actually the third Investor Day I've participated in as part of the team. And there was excitement surrounding each of those previous Investor Days, but this one is different. The energy is higher this time, and I am more excited about what the team is doing and what the future holds than I have been at any time during my extensive career with the company. Timken is well positioned for the future, and we're moving with urgency to deliver on the Elevate to Outperform plan. Today, I'll walk through the 2028 financial targets that Lucian outlined. I'll explain the revenue growth algorithm and the margin outlook, and I'll show how the actions you heard about earlier translate into significant earnings growth. I'll also cover the impact of our portfolio 80/20 actions, including the automotive OE exit and the belts divestiture, and explain why those moves matter. Finally, I'll lay out our capital allocation framework and the optionality we have because of a strong balance sheet and significant free cash flow expected. My goal is simple: show the transparent math behind our targets and why our plan is realistic, actionable, and value-creating. We're not just betting on a market recovery. We're reshaping the company to earn higher growth and better margins, regardless of the cycle. So we launched our transformation program in January of this year to take our performance to new levels. This is a full company effort designed to sharpen our strategic focus and drive measurable results. With a dedicated transformation office reporting directly to me, we have clear accountability across the business governing execution across revenue, cost, and investment initiatives. We have strong early traction with 17 structured work streams putting 80/20 into action. Our priorities are how we grow, how we manage costs, and how we deploy capital, end to end. Before I get into the math and targets, though, I want to spend a few minutes on how we'll actually execute and measure our progress. At the heart of this transformation is the 80/20 mindset. It's something we've already mobilized across the company, and I couldn't be more excited about the financial benefits. Why am I so confident? After 25 years working in and around the bearing business, from the plant floor to strategic planning, I've seen firsthand what complexity costs us. The 80/20 approach to our transformation is about ruthlessly focusing on the things that create disproportionate value, the products, customers, and processes that truly move the needle. It isn't a short-term cost-cutting program. It's a strategic simplification that frees up people, cash, and capabilities so we can invest where Timken can win. I believe in this 80/20 approach, and frankly, why I get so excited, because it removes complexity that slows us down and consumes margin. It frees resources to accelerate growth in our strategic verticals. It makes the business more predictable and easier to scale globally, and it creates space to invest in R&D and go-to-market muscle where we get the best returns. Put simply, 80/20 gives us leverage. It lets us redeploy talent and capital into higher return initiatives and accelerates the margin and growth story we're presenting today. To ensure we convert initiatives into outcomes, we've set clear KPIs and a tight governance cadence with weekly workstream checkpoints, bi-weekly integration updates, and monthly executive reviews. Key indicators that we're using include things like SKU reduction percentage, application engineering hours redeployed to strategic verticals and customers, margin accretion from portfolio actions, R&D spend on prioritized platforms, and working capital days improvement. And as Tim mentioned, we've already started SKU rationalization actions, and that simplification will allow better line balancing that improves both throughput and reduces urgent expedite costs. And finally, we'll be transparent about our progress. And of course, we will course correct quickly where needed. Overall, these actions that are underway to transform the core, along with the team's 80-20 mindset, form the pillars of the Elevate to Outperform program. The bottom line is this: the execution of the strategy that you heard today is expected to directly translate into compelling financial outcomes, including accelerating growth and margin uplift through 2028. This is not theoretical, it's operational. Simplify, redeploy, invest, and leverage the power of one Timken. Starting in 2027, we expect to show tangible margin improvement from portfolio moves and early 80-20 actions that will be visible in segment margins and improved working capital conversion. Collectively, the combination of redeployed resources, higher R&D effectiveness, and platform expansion should materially contribute to our revenue and margin targets. Importantly, this success is repeatable. With a simpler portfolio and concentrated go-to-market, Timken will become faster, more predictable, and more capital efficient. The 80-20 discipline is not new, but it is the right lever for Timken right now. It's about creating the runway for our best talent and best products to scale globally. That's how you turn capability into superior returns and how you build a company that thrives across cycles. 80-20 is the practical engine behind our transformation and the numbers I'll walk through today. So let's talk about the revenue growth algorithm. Our target is mid-single-digit organic growth annually through 2028, outpacing the market by more than 100 basis points per year. Starting from roughly $4.6 billion of reported sales in 2025, portfolio actions like the auto exit, Belts divestiture, and the recent Bijur Delimon acquisition create a cleaner pro forma 2025 base of about $4.4 billion. From that base, growth comes from three places. First, the underlying market growth, including pricing, which contributes about 350 to 400 basis points of the CAGR. Second, outgrowth from our strategic verticals for an incremental 50 to 100 basis points annually. And thirdly, global platform expansion adds another 30 to 50 basis points annually, including the aggressive industrial motion regional expansion, which Tim highlighted earlier. Collectively, these actions drive more than 100 basis points of annual outgrowth versus the underlying market and bring us to a 2028 revenue range of $5 to $5.2 billion. We expect adjusted EBITDA margins of 21 to 23% in 2028, roughly a 500 basis point improvement versus 2025 at the midpoint. This would be a new record for Timken. The drivers break down like this. First, we expect a positive 100 to 150 basis point contribution from the operating leverage on market growth. Keep in mind, this is net of incremental investment we're planning to help accelerate growth as part of the transformation plan. Again, the reduction in complexity as part of 80-20 will free up resources that we intend to redeploy to help support our growth initiatives. And we're also planning to increase R&D expense over the time horizon, which would be embedded in that line, for example. Next, we're forecasting a 150 to 200 basis point margin gain from portfolio optimization related to the automotive exit and Belts divestiture. I'll cover these respective actions in more detail in a few moments, but you'll notice that this is the biggest driver on the margin bridge and is in our control with actions already underway. With respect to the strategic verticals, the outgrowth we are targeting is expected to contribute 100 to 150 basis points to the 2028 margin target. And then our global platform expansion as part of Pillar 3 is driven primarily by outgrowth within the margin accretive industrial motion platforms, such as linear motion and automated lubrication systems. What I want to emphasize is that most of the margin increase is within our control through execution and portfolio actions and not dependent solely on volume recovery. So here's the first of the portfolio actions I want to highlight. We're reducing automotive OE exposure in a phased way, as Tim highlighted earlier. Actions already underway set us up to exit about $150 million of revenue through 2028. That exit is expected to add about 150 basis points to engineered bearings segment margins when complete, and it frees resources to redeploy into higher return areas. We're applying that same portfolio 80-20 discipline in industrial motion. Our recent announcement to divest the belts business allows us to materially improve the structural profitability of the segment and simplifies our portfolio, generating more than 200 basis points of margin improvement on a run rate basis and roughly $100 million of revenue removed from the segment. On a pro forma basis, industrial motion EBITDA margins rise above 21% just from this action. And this action will be accretive to EPS in 2027. And it lets us, of course, redeploy resources into our strategic growth verticals. This next slide provides details on the 2028 outlook for sales and margins by segment, inclusive of the portfolio optimization in both segments I just highlighted. Both segments are expected to contribute to total company sales growth, but you can see that the CAGR is meaningfully higher for industrial motion. Industrial motion is indexed to relatively higher growth markets like robotics and automation and has more regional expansion opportunities as part of Pillar 3. In addition, the engineered bearings segment has a higher revenue impact expected from portfolio optimization. I want to reiterate what I said a few slides back, that our mid-single-digit organic growth rate is higher than the total sales CAGR we show here, since this includes the impact of the portfolio optimization. Both segments are expected to reach record margins in 2028, led by industrial motion expanding by around 700 basis points at the midpoint versus 2025. Just to reiterate, most of this margin expansion is driven by disciplined execution of Elevate to Outperform, and about 1/3 of it is from the portfolio actions already underway. And that margin expansion is a critical driver to our higher earnings and free cash flow trajectory. Timken has also proven its ability to consistently generate strong free cash flow, which will fuel our strategic initiatives and enable us to continue returning capital to shareholders. Overall, we generated approximately $1.1 billion of free cash flow over the last 3 years. More importantly, we're expecting to generate around $1.3 billion in free cash flow over the next 3 years in total. This represents a $200 million increase versus the prior period, based on around 95% conversion of GAAP net income, with the higher margin outlook being an important driver, along with our 80-20 simplification actions, which will help unlock working capital. And here is our disciplined capital allocation framework. We're effectively compounding this strong free cash flow and utilizing our investment-grade balance sheet to fuel our growth initiatives while consistently returning cash to shareholders. Investing in our core business remains our #1 priority, as it generally produces the highest risk-adjusted returns on capital. We're targeting CapEx in the range of 3.5% of sales, which compares to the company's previous range of 3.5% to 4%. Our capital intensity is expected to continue to move lower over time as industrial motion becomes a larger percentage of the overall company and we more efficiently leverage our existing asset base through our 80-20 mindset. Second, we expect to continue to pay an attractive dividend that grows over time. The expected payout ratio this year is below 25% of adjusted earnings, and we think the payout ratio will remain below 25% over the foreseeable future, given the significant earnings growth we expect. I'll cover M&A and share buybacks further in a few minutes, but both remain very attractive options for deploying capital to enhance our earnings power and maximize returns. And finally, we're still targeting net debt in the range of 1.5 to 2.5 times adjusted EBITDA, which is the foundation of our capital deployment framework and is in line with a low to mid BBB investment grade credit rating. Another point I'd like to make here is that return on invested capital comprises 30% of the long-term incentive plan for our leadership team, so disciplined capital deployment is especially important. And the free cash flow generation and strong earnings growth expected provide significant capital deployment optionality over the next 3 years. Based on the cash flow and EBITDA outlook, we expect to have $2.4 billion in total capital to deploy over the next 3 years, while still maintaining a net leverage ratio at 2 times. Note that this includes $1.6 billion in cash available to deploy towards M&A and share buybacks. And keep in mind that our 2028 targets do not include incremental M&A and share buybacks, which represents upside. Let me focus a bit more on the potential capital deployment optionality specific to acquisitions and how we think about M&A. On the right side, you can see listed the core principles for future acquisitions. With respect to fit, Timken needs to be a natural owner of a target, and it should have alignment with the strategic verticals we've detailed. Additionally, an acquisition needs to be financially attractive with the intent of maintaining the company's investment grade rated balance sheet. And note that when we consider M&A, we do that relative to buybacks as an alternative. Timken has demonstrated a strong history of returning capital to shareholders with nearly $2 billion returned through dividends and buybacks over the last 10 years. And returning significant amounts of capital to shareholders is expected to remain an important element of capital deployment over the coming years. You can see we've delivered 12 consecutive years of higher annual dividends, and 2026 will mark 13 years based on the recent quarterly dividend increase approved by the board a few weeks ago. Since 2013, we have reduced our share count by approximately 25% on a net basis. We currently have authorization to repurchase up to 10 million shares through 2031 and have been actively buying back stock thus far in 2026. Given where our stock is trading and the confidence we have in the future earnings power of the company, we would expect share repurchase to remain an attractive use of capital. Let me now turn to our balance sheet, which remains a key strength of the company. Today, we are reaffirming our net leverage target range of 1.5 to 2.5 times. Note that we maintained leverage right at around 2 times the last few years, as we've paid down debt levels to offset the declining EBITDA from an extended period of lower end market demand. Overall, our balance sheet puts us in a great position to drive shareholder value creation through capital deployment. So let me close on the summary of our 2028 financial targets that Lucian highlighted earlier. The bottom line is this: we expect significant sales growth, margin expansion, and higher earnings over the next 3 years, driven by Timken's Elevate to Outperform plan. These would all represent new records for the company and really demonstrate that we're building a more simplified, higher growth, and higher margin Timken company. Thank you all for your time today. I hope you can sense the excitement we have for the future earnings power of the company and the value creation potential.